So I'm going to tell you the secret to marital harmony. Would you like to hear that?
Of course.
Okay, gentlemen, put the seat down when you're done. Ladies, make sure the seat's down before you plop down. And everyone, change the toilet paper roll when it gets low, and don't expect to get a freaking medal for doing that. Just do it, right? Just do it. Okay, questions?
That's all you need.
Yep, there you go. Okay, so last time we ended up here, constant dividend growth, and I had this formula up here, and we're going to take this formula and we're going to rearrange it into something called the dividend growth model. You may also hear it called the dividend discount model. Either way, here it is. We're going to take that and rearrange it, and we're going to do some algebra magic. Some of you folks are going to be blown away by this, but what we're going to do is we're going to multiply both sides by r minus g, and then we are going to get r by itself. And that gives us this thing called the dividend growth model. And that first part, d1 over p0, has, oh, for shame, he's late, has a special name. We call it the dividend yield. The dividend yield. Hopefully you guys remember that when we talked about it a little bit before. That's the dividend yield. Now we remember that total returns are equal to two things added together. The dividend yield plus capital gains yield. And we see that the only thing left hanging out here is G. What does that mean about the relationship between G and the capital gains yield? Yeah, they got to be the same thing, right? They got to be the same thing. So in a stock with constantly growing dividends, the capital gains yield is the same as the growth rate of the dividends. Let me say that one more time. The capital gains yield for a stock with constantly growing dividends is the same as the growth rate of the dividends. And in fact, we can think of the capital gains yield being the growth rate of the stock price. And that means that the stock price and the dividends are growing at exactly the same rate. Exactly the same rate. So this makes things easier when we get down the road to figure out some things. And we'll get to that here shortly. Now, here's the third kind that we are going to discuss, the differential or supernormal dividend growth. This is where dividends grow quickly up front, and then they slow out to be shallower later on. So, new companies, we discussed last time that they may grow their dividends faster in the beginning and then more slowly over time. The bad news is there is no slick algebraic way for solving this, but I will teach you a method. And in fact, I would write this process on your note sheet. And the process goes like this. Find the individual dividend amounts up to the start of constant growth. Make a note. You do not get D0 unless you are told otherwise. You do not get D0 unless you are told otherwise. So we'll just write that down. Number two, find the price of the stock at the start of constant growth. Find the price of the stock at the start of constant growth, and then we're going to find the present value of those individual dividends and that stock price. And here's why that gives us the overall stock price. That stock price that we figure at the beginning of constant growth represents the value at that point of all the dividends going forward beyond that. And so we've compressed all of those dividends going out to the end of time to a single number. And now using those dividends, the individual dividends, and that price, we can figure out what is the overall stock price. So the best way to teach this is through an example. But I want to tell you how to read these things because they're going to give you dividends and you're going to have to figure out whether they've given you D0 or D1. D0, let's see, just paid would be something that indicates they've given you D0. Or last dividend clause. That's also D0. What if they say next dividend? That's D1. Or in 1 year? Obviously, D1. So basically, if we've got past or present, that's going to be treated as D0. If we've got future, oh, I can't spell future today. Someone stole the eraser. Thieving bastards. Okay, here we go. This is my own personal eraser. I bring it with me everywhere. Okay. That's sad, isn't it? Okay, so that's going to be future less than or equal to 1. What if they say the next dividend will be in 3 years? If it says in 3 years, that's D3, right? Does that make sense? And we're going to see some of that. Okay, so here we go. Company plans to pay a dividend of $1.15 1 year from today. What is that? Is that D1 or D0? D1, right? They plan to pay 1 year from today. Then over the next 4 years, this dividend will grow at 15% per year. After that, the growth will settle down to 10% per year. Now, here's the problem. People have trouble figuring out where does constant growth start. And so we're going to do something called the kindergarten method that will help you to easily get through this. So after that, the growth's going to settle down. What's the value of 1 share today if the required return is 15%? First thing you start is by drawing a picture. I guarantee you some of you will come to my office to see your exams, and you'll say, I don't know why I missed this one. And I'm like, well, you didn't draw a picture. So that's where I would start drawing the picture. This is what the picture looks like. We've got times 0. Notice nothing at times 0. Even if we had started out with dividend 0, would it be on this picture? No, because we don't get D0 unless you're told otherwise. We've got $1.15 there at D1, and I'm going to draw some arrows here indicating these dividends. And they say after, they name D1, and then they say the next 4 years. So I'm going to start at the last named dividend and then go, I'm going to use my finger, by the way. So here we go. Are you ready? Can you guys see the arrow, the cursor? Here it goes. 1, 2, 3, 4. Now I know where continuous growth starts. The kindergarten method has never let me down. So do the kindergarten method, figure out where that continuous growth starts. So what does that mean we need to figure out? We need to have D1, D2, D3, D4, and D5. And then we also need to figure out what? P5. So that time 5 cash flow is going to be a combination of 2 things. It's going to be a combination of D5 and P5. Most common mistake, people forget to add back D5 when we're going through this. Okay, so let's walk through this on your calculator. We're going to say CF, second, clear work. What do I put in for CF? 0? Nothing, right? Because we don't get D0. Arrow down. What is C0? 1. 1.15. And I want you to do 2 things here. I want you to hit enter, and I want you to hit store 1. You'll see why here in a little bit. And we're going to arrow down. It only happens once. Arrow down. So what's C02? Well, here's some magic for you. D1 is equal to D0 times 1 plus G. Do you guys see how that works? That means D2 is equal to D1 times 1 plus G. So really, all I've got to do to find D2 is take D1 times 1 plus G. What's G in this regime right now? 15%. Very good. So here's what I'm going to do. I'm going to say, I'm here in slot number 2. I'm going to say recall 1. That brings back my D1. I'm going to multiply by 1.15 because the growth rate is 15%. And that gives me 1.3225. I'm going to do 2 things here. I'm going to enter, and I'm going to store. Any idea where I'm going to store it? 2. Very good. Someone said 3. I'm going to let that slide. Okay, arrow down. What's F02? Do we have any dividends that repeat here? No. Arrow down. How am I going to get C03? What should I say? Recall what? Recall 2. And then what do I do? Multiply by 1.15 equal, what do I do now? Enter and store 3. arrow down, arrow down. C04, what do I do? Recall 3 multiplied by 1.15 equal, enter, store, 4. Very good. Arrow down, arrow down. C05. How am I gonna start this? Recall what? Yeah, recall 4 multiplied by what? 1.15 equals, I'm getting 2.01111. So I'm gonna hit enter here, although we're not done yet. I'm also gonna say store 5, and this is very important, this store 5, and you'll see why here in a minute. Okay, so now we have, so we know that P5 is equal to D6 divided by R minus G. And it's going to be the new G. So we're going to put a little G2 down here. But do we know D6?
No.
No, but what can we do?
D5 times 100.
Yeah, so it's going to be D5 times 1 plus G2 divided by R minus G2. Does that make sense? And that's going to give us the price at time 5. So I've got D5 on the screen right now. And I'm going to multiply by 1 plus G2. What is G2?
1.1.
Yeah, so I'm going to multiply by 1.1 because it's 10%. 1.1 equals divide by, open parentheses, required return they told us is 15%.
10.
Minus, yeah, G is 10, 0.10, close parentheses, equal. That number right there represents P5. That number right there represents P5. Is that my entire time 5 cash flow? No. What do I have to add back?
D5.
D5. So I'm going to say plus recall 5 equals, and then I'm going to hit enter. Everybody with me? Okay, now if I wanted to find the present value of all those cash flows, what button should I hit next? NPV. What do I put in for I? 15. Enter. Arrow down. What should I do here? Compute. And we see that the per share price is 27. Now how do we know that's the per share price? Because the dividends we were given were per share. And so when I take this present value of all those things, that's going to give me the per share price. And so you can walk through all that on your own later on if you want, but this is exactly what we just did. Now, I know that I made that look really, really easy. Do you think it's that easy? No. The first 6 years I taught this material, I never got that right the first time. I always screwed something up. And that's why I've developed this method with the storing and the things like that. The method that I just demonstrated is absolutely, positively the simplest and most accurate method that I know of to perform this operation. Now, how many of these do you think I will put on the exam? 1. What should you do when you see this? Skip it and come back to it when you've got 20 minutes left and you're thinking about dinner, and you come back and make this magic, right? Start by drawing the picture. Now, would I recommend that you watch this segment of the video again? Absolutely. Absolutely. And in fact, I believe I've got one where you can actually see what I do on the calculator. So you could look at that, and that should help you out. But as far as crippling your ability to do well on the exam, one problem is not going to do that by itself. Questions? Okay. So let's talk about estimating G. It's not just handed down to us by the gods of finance. And so there are a couple of ways that we can do this. One is the historical average dividend growth rate. If I've got a stock that paid $1, and the next year it paid $1.10, and the next year it paid $1.21, If you go do the math, you'd see that the average growth rate was 10% per year. And that would be my estimate of G. And with companies like electrical utilities that this model is good for, that's fairly good. Here's the problem, though, with dividends. This constant growth rate assumes that dividends go like this. Do you think that's what it looks like in real life? No, dividends go up, they'll go up, then they stay the same for a while, then they go up, they stay the same for a while, they go up, they stay the same for a while. So basically, this is just an estimation. And by the way, the stock pricing models that I show you in this class, do you think you can go out and calculate a price on a stock and say, oh, wait a minute, the market is undervaluing this stock. I should buy it right now and get rich? No. No. Why am I teaching you these valuation models? So you'll understand what goes into the price of a share of stock. For example, if the required rate of return is higher, that means that the stock price will be lower. If the growth rate is higher, what does that mean for stock price? Yeah, it's going to be higher. Because of course you would be willing to pay more for a stock that's going to grow faster than one that was not. Okay, the second one is to take the retention ratio, which you guys remember hopefully from chapter 3, and multiply it by the return on retained earnings. Now, so remember the equity that we have to invest comes from retained earnings. And what is the return on retained earnings? Well, retained earnings are in what section of the balance sheet? Are they assets? No. They're not liabilities, they're equity, right? And so the return on retained assets would be the return on equity. So we're going to take that retention ratio, multiply by the return on equity, and that gives us G. Now, you may notice that looks suspiciously like the sustainable growth rate, which is ROE times B divided by 1 minus ROE times B. Looks suspiciously like that. And you'll see these kind of used interchangeably, because actually this isn't going to make that much of a difference down here unless ROE times B is huge, right? In fact, when you take the CFA exam, you'll use B times ROE. Unless they've changed it since 2010, because that's when I took it, right? Okay. Oh, I feel old. Okay. Those are your two ways to estimate G. Any questions? If I give you 4 former dividend values, which way are you going to use? Yeah, the historical average. What if I give you the dividend payout ratio and the profit margin, the total asset turnover, and the equity multiplier? Yeah, the second one. Now, that would be a lot of work, right? Would I be so cruel as to throw that at you? You know, usually yes, but today I'm feeling generous. Probably not. Questions? Okay. This is the one thing you guys got out of it. I don't need to know this. Okay, so here's the cautions using the dividend growth model. Your estimate of G is your estimate of R is very sensitive to your estimate of G. What if my estimate of G is 1% too high? Then my estimate of R will be 1% too high. And remember that present value equal future value divided by 1 plus R to the t. So when I'm doing this time value of money calculation for net present value, if my estimate of R is 1% too high, because my estimate of G is 1% too high, this thing on the bottom is going to be too big, and the present value of my future cash flows are going to be too small. And so that's going to lead to me having a more negative net present value than I should. It's going to lead me to potentially rejecting some good projects. Now, let's look at the other side of this. What if my estimate of G is too low? My estimate of R will be too low. And when I divide by a smaller number, I get a bigger number here, which means my estimate of net present value will be too high, which means that I might accept some bad projects. I might accept some bad projects. Now, what do you think is worse for your career? Rejecting good projects or accepting bad projects? Accepting bad projects. I've got this dear friend, Joe, and we worked at a company together up in Ohio, and he made an error like this, and we accepted a bad project. We built a plant. I could give you the address of the plant. You could actually look it up online. Boop, there it is. It turned out to be a negative NPV project because he like diddled up the math here. Now, whenever I would drive by there, I'd like, whoop, there's Joe's mistake, right? It's there forever, right? Probably still there. Okay, now, so you say, well, wait a minute, I've got an idea. I just won't accept any project, and then I'll never be guilty of accepting a bad project. Folks, I'm paying you $100,000 a year to figure out what are good projects and what are bad projects. If you can't ever bring me a good project, I've got a positive NPV project of my own. I'll fire your ass and save myself $100,000 a year, right? Does that make sense? Okay, now what does that mean? When you're on the borderline, always default to rejecting because it's just too dangerous. Questions? Okay, so now let's talk about what growth opportunities do to stock value. And we're going to start out talking about the firm as a cash cow. Now, for those of you who are unfamiliar with the life of the cow, if she's lucky, she becomes a milk cow. And she gets milked, and she gets milked. By the way, cows get milked twice a day, and it's the same amount of milk every time. So bam, bam, bam. That's what a company without growth opportunities looks like. Because they're not making any more money, they're making the same amount, and because they've got no growth opportunities, they should be paying out all of their earnings as dividends, right? They should be paying out all of their earnings as dividends. Now, in truth, cows actually appear more like bonds than stocks. And here's why. Milk, 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 milk. After her last milking, what do? Steak, yeah. Oh, you can sell her, well, in fact, you're going to sell her to the stockyard. Stockyard's going to sell her to McDonald's. Then you're going to see her again the next time you go for a Big Mac, right? I know, isn't that terrible? Some of my students have not realized that burgers come from cows. Okay, so back to the story. So we call a firm with these dividends that repeat over and over and over again a cash cow. And we know that we can value a firm that has constant dividends as D over R. And I don't have to say D1 or D5 or D12 because they're all the same, right? Okay, so if I assume, because it's a cash cow, they don't have any growth opportunities, they're not reinvesting any of the net income, they're paying it all out as dividends, that means that the price per share of a cash cow is just the earnings per share divided by the required return. It's just the earnings per share divided by the required return. Now, if the dividends stay the same forever, we said that the stock price grows at the same rate as the dividends. What does that tell us about the stock price? Yeah, stock price should stay the same forever too. Now, we're going to use this as the foundation to build off of, to show what growth opportunities do for the value of the firm. If the firm has growth opportunities, then they're going to add value based on their net present value. In fact, we're going to take the net present value of every single project at the company, we're going to add them together, and we're going to divide by the number of shares outstanding. We're going to divide by the number of shares outstanding. And that per share per share amount of net present value is going to be called NPVGO, or the net present value of growth opportunities. And so what we'll be able to see here is that the price of a firm with growth opportunities is going to be equal to the cash cow portion, the part that just keeps spinning off the profits, plus that per share measure of net present value of growth opportunities. What's the goal of financial management? Maximize shareholder wealth. And so if you have growth opportunities, of course you'd like to seek those out. So let's talk about a company called Google. There is a baseline of earnings per share that is coming from the cash cow portion of their business. What is the cash cow portion of their business? Selling advertising on the search engine, right? Is that really growing? No, but it's just spitting out a nice constant set of cash flows. Now, Google is out there and they're doing all sorts of crazy stuff that's in this NPVGO region. Can anyone give me some examples of the crazy crap that Google is trying in that area? Quantum computing chips. By the way, how far out is that before it creates profit for the company? Pretty far out there, right? Now, what about some stuff they've done in the past? How about Google Glass? You guys remember Google Glass? Everyone laughs because it's a freaking punchline, right? The people that wore them, and they called them what? Glass holes. Okay. So things have moved along then. I have a pair of smart glasses, but I only wear them like out in the street. I'm not like going to wear them in here. I don't want to freak you guys out. They are great for listening to stuff while I mow the yard. Back to the story. Also good for taking pictures. Back to the story. So Google is undertaking a bunch of this stuff out in this region. Is it all going to pay off? No. But the expected value, that's the NPV, that's what we're throwing in there. Now, what does that mean? If their job is to maximize shareholder wealth, they should be trying to maximize this NPVGO, which means they should be accepting all positive NPV projects, which is kind of one of our big rules in corporate finance. Accept all positive NPV projects. Questions? Okay, now why am I beating around on this? Because I'm going to show you now how this relates to the PE ratio. We talked about the PE ratio back in chapter 3. It's the price per share divided by the earnings per share. And we can think of it as how much investors are willing to pay for $1 of current period earnings. And of course, they're going to be willing to pay for $1 of current period earnings more in a firm that's growing faster, right? Because it means their NPVGO is greater. So PV is going to vary between industries. Can I compare the PV of an electrical utility and Google and say, well, Google's is higher, it must be a better company? No, absolutely not. They're in different industries. So what do? I compare between firms in the same industry. Hopefully I find something that they're almost identical. For instance, Lowe's and Home Depot. Lowe's and Home Depot. If I go out right now and look at the PE ratios for both those firms, whichever one of them has the higher PE ratio, that's the one that investors expect to grow more. Does that make sense? Okay. So we are going to use this NPVGO model to show you about what how PE ratio comes about. If I take both sides of this equation and divide by earnings per share. Over on the left-hand side, that gives me P sub 0 divided by EPS, which is the PE ratio. And so what's left over then? Well, first of all, we have a term that's 1 over R. This term has to do with the risk of the firm. The higher the risk, what happens to R? If risk is higher, what happens to R? Yeah, it's got to be higher too. And when I divide by a bigger number, it becomes worth less. And so the riskier the firm is, the lower the PE ratio will be. Ceteris paribus, all else equal, the riskier a firm is, the lower the PE ratio will be. Now, what about the second part? NPVGO divided by EPS. That's talking about the proportion of That's talking about the relative size of the net present value of their growth opportunities versus their current business. The current business is EPS. The NPVGO is the net present value for growth opportunities on a per share basis. And so the higher that this second term is, the higher the growth is, the higher the PE ratio. So if I were to look for a firm with the absolute highest PE ratio, it would be a very safe firm with very high growth. By the way, does such a thing exist? No, the very nature of high growth means it's going to be risky. Typically what we see getting the emphasis in this calculation is the growth, not necessarily the risk. So let's talk about some PE ratios here. ExxonMobil, and by the way, these are, it seems like I updated these yesterday, but it's been 10 years ago. ExxonMobil, 12.6. By the way, a lot of growth opportunities there at ExxonMobil. Do you guys think people are just going out and drilling holes like crazy?
No.
No. And so we see that their PE ratio is relatively low. Then we have an electric utilities firm, and I have to tell you, I was surprised to see a PE ratio of 15.5 on this, because in 1983, when I was helping my dad keep track of his stocks, the PE ratios for electric utilities were between 7 and 8. And so that really struck me as odd. Here's a good one, Newmont Mining. It's got a PE ratio of 19.93. At that point, by the way, do you think gold mining is an intrinsically safe undertaking? No, because gold prices jump around, right? And we already discussed that it's the price of gold that determines their top line on their income statement. And so it really has to be about growth. Check out Starbucks, 31. Holy crap. Okay, so here's how Starbucks, in my mind, how I'll always remember it. My wife and I moved to Hattiesburg, Mississippi. On the first way into class, I see a Starbucks. I'm like, oh, hey, look, they've got a Starbucks. And my wife's like, oh, okay, cool. And then 2 days later, we're driving back in to teach again, and I'm like, oh, crap, there's another Starbucks. They were like popping up like weeds. Now, it grew, but then basically they saturated the North American market. So where do you think they say they're going to go next? Yeah, overseas. In particular, they're going to China. Now, I'm going to ask our resident China expert, Ms. Gann. Is China a tea culture or a coffee culture? Tea! Yeah, they've got ceremonies, and I have students bring me gifts of tea. I'm not telling you to do that, because I don't drink tea. But it's very meaningful, right? The tea thing. And so I'm like, man, they're so full of crap. China's a tea culture. That's not going to work. But then, 2011, I go over there to teach, and it was dark when we got there. And the next morning, I step out in front of my hotel, and I'm stretching. I look across the street, and bam, there's a Starbucks, and there's a line. And I get to class. And by the way, Chinese students eat their breakfast in class. And so these people are all sitting there, and they've got Starbucks cups. And then I said, is that really Starbucks, or do you just have the cup? Right? Because sometimes people will use it as a status symbol. They're like, no, it really is Starbucks. And I said, is it tea or coffee? You know what they said? Coffee. It was coffee. Starbucks got Chinese people to drink coffee. I'm like, damn. And then Starbucks says, okay, well, we've kind of done China now. We're moving on to India. And what do the Indians say? Well, the northern part of India is a what culture? Tea!
Yeah.
The southern part of India is a coffee culture. So it's okay, they'll do okay in the south, but the north, not so much. At that point, I'm like, nope, I'm not going to bet against Starbucks, right? I'm not going to bet against Starbucks. So the reason that Starbucks growth is PE is so high was because of the growth. I bet money, if you looked at it today, Starbucks PE ratio would be lower, because there are only so many coffee outlets you can put out there. And the other thing is, in China, people have figured it out. It's not that expensive to make a cup of coffee, so we'll have our own local chain called Luckin Coffee. And they spread like wildfire and basically are killing off Starbucks. So I'll bet the PE ratio will be lower today. Let's talk about Walmart and Costco. Walmart and Costco are basically in the same business, except for Walmart is basically saturated, at least in the North American market, and they haven't had a lot of luck overseas. In fact, they've had to shut down some stuff overseas. As a result, we see that Walmart has a much lower PE ratio than Costco. Costco is primarily on the coast. We only recently got a Costco here in Springfield. So what does that mean for Costco's opportunities to expand? Much greater than Walmart. I will also tell you that Costco does a much better job of executing, meaning of doing the job, right? Of getting things done. I have never walked through a Costco and nearly threw up because someone was changing a diaper in the aisle, because they discourage that kind of behavior. Walmart, phew, perfectly fine, right? Okay, Let's talk about Apple and Lenovo. Two more businesses that are basically the same business, selling electronic gadgets. Does Apple make expensive stuff or cheap stuff? Expensive stuff. Who has the money to pay for expensive stuff? Rich people or poor people? Rich people, right? Now, what are there more of? Rich people or poor people? Poor people. Let's talk about Lenovo. Lenovo is making similar stuff, but at a lower price point. It's going to be Android, but, or now they're even having to change over from that. But long story short, their stuff is at a lower price point. And so if you look in North America, maybe we can all afford iPhones. If you go to, I'm picking on India today. Can everyone in India afford an iPhone? No. Are there people? Yes, it could be like your annual salary. But do most people have smartphones?
Yeah, they do.
Yeah. In fact, India is actually ahead of us as far as electronics transactions and that sort of stuff, electronic banking. Okay, now, where do those phones come from? They come from places like Lenovo. So who's got the greater growth opportunity? Apple chasing the richy riches of the world, or Lenovo chasing the poor people? Lenovo. By the way, is it wrong to make a profit off of doing business with poor people?
No.
Absolutely not. Every time you and I engage in a transaction, it's because both of us feel we're going to be better off for having done it, right? And if you're creating a product that is available to and affordable by poor people and you happen to make a profit off of it, great. You're not forcing them into that transaction. So don't ever let anyone tell you it's immoral to make a profit from doing business with poor people. Okay, now let's talk about, skip Yahoo and Google. Yahoo's so over. Forget it. Let's talk about Pfizer and AstraZeneca. So Pfizer and AstraZeneca are both pharmaceutical companies. And for pharmaceutical companies, this NPVGO is composed of what is called their pipeline. What is the pipeline for a drug company?
So the new products?
Yeah, the new products. And it's really interesting. There is a lot of transparency here because when they are developing a new product, at every stage, they have to submit reporting to the United States government, and then it becomes known to everyone, right? Because the government's really lousy at keeping secrets. No, it's because it's public knowledge, right? And so you can see that stage 1, they're okay for animal trials. Stage 2, they're okay for primate trials, which is we're going from rats to monkeys. And now we're okay for a small human trial, and now we're okay for a large human trial, and then finally there's going to be an approval, we hope. You can see what's going on through the entire pipeline. Knowing how that works, who's got a better pipeline based on the PE ratio? AstraZeneca or Pfizer? Yeah, AstraZeneca has to be, right? Because it's got the higher PE ratio. Does that make sense? Okay, now, at the time that I took this snapshot, Amazon's PE ratio was NA. Because at the time, Amazon had negative EPS. You cannot calculate a PE ratio when you have negative earnings per share. And you can't do it when you have 0 earnings per share. For the longest time, this is what would happen. Amazon would keep reinvesting in the business, actually investing more than they were bringing in, constant losses. And then people would say, we're about tired of Amazon and this crap, and what would Jeff Bezos do? Oh, they've reported a profit, and the stock would skyrocket. And then what do they go right back to doing? Lose money, lose money, lose money. Now, they did that for a long time. Now they're finally profitable. So, but it took a while to get there. The point of having this on here is to tell you if it's the earnings per share is 0 or negative, you cannot figure a PE value. Questions? Yes?
Is it possible for a company to have a price to earnings of 1 or less?
Yes, in fact. So he's asking, is it possible to have a price to earnings of less than 1? No, actually, I'm going to take that back. So the earnings per share would be at time 1. The price is going to be at time 0. So it's possible for PE to be less than, yeah, if you assume that nothing's ever going to get earned again, it's possible to have a PE less than 1.
If you're the owner of Yahoo, what will you do? Will you wait for the company to die natural death, or would you dispose it at this time?
Oh, this is a good question. I think what you're asking is, when you see a company that's in trouble like this, do you sell or do you hold? Is that your question? Okay, when in doubt, sell. When in doubt, sell. Remember about bad projects? It's better to reject a good project than accept a bad project. And just because the stock price is coming down, does that mean the stock's on sale? Oh, no. I will tell you a story from my own, before this, back when I was a mechanical engineer and thought I knew everything, right? So a buddy and I are invested in this company called Lucent. And we paid $31, this is during the dot-com bubble. We invested $31, and then the stock price fell to 22. And he's like, dude, we should buy some more. I'm like, okay. So I buy some more. And then it falls down to 7. And he's like, dude, I'm loading up. I'm like, forget that. No way. Oh, only I didn't say forget that, right? I said something else to start with that. Bad. What do you think happened with Lucent? 0, right? It's dead. Like it's dead like a carp. Okay, it's dead. So there's your answer. If I find myself in a situation where something's going south, I'm going to sell it and cut my losses. Even if I had been a shareholder in Hostess when I saw it going down and I realized it's actually a good business model, it doesn't do me any good to hold on to the stock, because who's going to end up owning the firm? The bondholders, right? Yeah, I am so tired of writing stuff down. Writing, R-I-D-I-N-G, writing stuff down. I'm like, forget it. If it starts to go, whoop, kill it off. Now, that's if I were a stock picker. Am I a stock picker? No. How many shares do I own? 1,100, right? 1,100 different companies. Do you think I keep an eye on all 1,100? No. Does that help you out?
Does this apply to cryptocurrency at all, where it's tough?
Cryptocurrency is crap. Might as well call it cryptocurrency. It's so cryptocurrency runs on something called the bigger fool theory, right? I know this crap is worthless, but I'm willing to pay $1,000 for it because I assume some jackass will give me $1,005 tomorrow. Now, does that mean that you will not go out and make profit on your crypto holdings? I bet you will. How long will it go on? Can't tell you. Will it be forever? The answer is no. Sooner or later, rationality returns. Does that help you out? Yeah. How many of you own cryptocurrency? It's just gambling. And no one's going to confess at this point, right? It's just gambling, folks. And it was like that in the dot-com bubble. Yeah, did I think that Lucent was worth $31 a share? Hell no. Did I think some other moron would pay me more money later on? Yeah. That's exactly why people are buying crypto now. Okay, so that's all for stock valuation. Now we're going to move on to stock features. So first of all, let's talk about, by the way, unless I say otherwise, everything I'm talking about is common stock. Everything I'm talking about is common stock. When we get to preferred stock, I'll let you know. So, first of all, dividends. Dividends are not a liability of the firm unless they're declared by the board of directors. For example, there will be a question on the exam. This says, ABC Corp has been paying a dividend of $1 per year forever. Must they pay a dividend of $1 next year? No! In fact, dividends are declared quarterly. If the company doesn't have enough to pay, they don't declare them. But if they're stupid enough to declare them and they don't have the money, the shareholders could actually, in theory, push the firm into bankruptcy, because once the board declares the dividend, then it becomes a legal obligation to pay. And if you don't live up to your legal obligation to pay, you can get pushed into bankruptcy court. Now, I think I'll give you an example of one situation where I think the board declared a dividend and then didn't pay it. Now, I could have my facts wrong because it's been a long time. Do you guys remember the BP Deepwater Horizon? Okay, that thing blows up, and our president at the time, Barack Obama, he tells BP, you guys better not pay a dividend. Now, why was Obama telling them they better not pay a dividend? What was he trying to preserve at the company? Cash, right? And why was he wanting them to preserve cash?
So the government didn't have to bail them out?
Yeah, so they could afford the cleanup, right? Right? Because if BP just BP turns belly up and walks away, who ends up paying the bill? The government. So it was a good move on Obama's part, and at this point, assuming they've already declared the dividend, it was a good move on the board's part to say, "Whoa, sorry, I'm not going to pay it." And it was also smart on the shareholders' part not to use that as an opportunity to push the firm into bankruptcy. Is BP shares worth more than zero today? Yes. And so even though a shareholder might find themselves with the opportunity to force the company into bankruptcy, probably not in their best interest to do so. Okay, now, that I have to reach to get that example because usually people are not going to declare a dividend unless they can pay it and do it comfortably. Payment of dividends. Oh, I need to swap the view here. Payment of dividends are not considered a business expense. Remember, interest is. And therefore, we subtract out interest before we calculate our taxes. But if you look at an income statement, the dividends show up after net income. And that's where we divide net income into dividends in addition to retained earnings. And so your dividends are not going to impact your tax obligation. Your debt will. And so there is a tax advantage to debt that is not shared by equity. And then, and they've messed with this last one. I think the percentage has just changed here recently, but there still is a corporate exclusion for dividends. So when I receive dividends as an individual, I must pay taxes on those dividends. When a corporation receives dividends, they are not required to pay taxes on all the dividends they receive. They're only required to pay on a percentage of them. And here's why. Remember back to our discussion of double taxation? The firm makes $1 and then they pay corporate tax and it gets passed on to the shareholder who has to pay dividend tax. Well, imagine a firm owning the shares of another firm. And that other firm has to pay corporate tax. Then it comes over here to the second company. They have to pay tax. And then it goes to the shareholder. And they have to pay tax. Folks, that's triple taxation. In this country, apparently double taxation is fine. But triple taxation is a taxation too far. And so that's why we have this. This isn't because corporate fat cats give money to campaigns. There's actually some logic to it. Questions? Okay, so let's talk about the shareholder rights. Shareholder, by the way, remember we said that equity owners make the decisions at firms, not the debt holders. So the shareholders are the holders of the equity. They get to make the decision. And how do they do that? They get to vote on things of great importance at the firm. For example, electing the board of directors. Electing the board of directors is one of these things of great importance that they get to vote on. Also, if the company has received an offer to be bought out, the shareholders get to vote on that. Things like that. Another thing, and this one is not true in every market, because in some countries we don't have the ability to do proxy voting. But proxy voting is basically the ability to vote your shares without going to the shareholder meeting. I constantly get these things, and now you get them through email. I used to get them in the mail. And they're called proxy ballots. And it's where you can vote for the directors and you can vote on these shareholder initiatives and whatnot. But knowing that I only own 1/1,000,000th of the firm, rationally, what do? I don't vote, right? I made one exception. Back in the day, Halliburton had a guy on the board called Lord Clitheroe. Now, I'm not voting for Lord anybody, right? So I would always vote against him. But other than that, Lord Clitheroe, God bless him, but not going to vote for him. Okay, so I know that's weird, but I'm weird. You knew that. Okay, so on with the story. Proxy voting. If you are in France, you don't necessarily have this. In fact, you don't have this. And so what does this mean? It means that small shareholders' voices do not get represented in countries without proxy voting. I'll give you an example. Let's talk about Marseille. Marseille is in the south of France, and it's beautiful. And so you are a dairy farmer in Marseille, and it is time for the shareholder meeting of Total, which is an oil company. It's not Total, it looks like it, but it's Total. And shareholder meeting of Total in Paris, or Paris. Now, it's about a 3-hour drive to get from Marseille to Paris, if my math's right. So the farmer would basically have to milk his cows first thing in the morning. Remember, cows have to be milked twice a day. And he'd have to jump in his Citroën, which is a French car, which I think literally means lemon, which fits. Drive to Paris, vote his shares, because he doesn't have proxy, right? Then he got to drive home and milk the cows. Do you know what the French dairy farmer says to that? Merde. If you don't know what merde means in French, ask a friend. Okay, so merde. It means shit. Okay, so he's not going to do that. And so what does that mean? It means that only the large shareholders' voices get heard in countries that have that sort of situation. In the United States, we're fortunate we have proxy voting. You also have the right to share proportionally in all dividend paid to common shares. What does this mean? If I own 10% of the common shares, by golly, I'm going to get 10% of any amount of dividends that get paid to common shares. Now, that makes, right now you're like, why wouldn't it be that way? We'll discuss something called classes of shares here in a minute. And we're going to see that even though they may have other differences, they have exactly the same cash flow rights as these shares. And then you also have the right to share proportionally in all assets remaining at liquidation after all liabilities have been paid off. And so we've paid off our taxes, we've paid off our workers, we've paid off the bondholders, we've paid off the preferred shareholders, whatever's left in this pot. If I own 25% of the common stock, I get 25% of whatever's left in that pot. That's what that last one means. Questions? Okay. Now let's talk about two different ways to vote. There is cumulative voting and there is straight voting. In straight voting, the seats are basically the board seats are offered one at a time, and we all have a vote. So assume that I own 51% of the shares in the firm, and you guys own the other 49%. Mr. Tips is standing for election. I like him. You don't. Who wins?
You.
I do. Ms. Holden is standing for election. I like her. You don't. Who wins? I do. Do you see that I get to elect the entire board, even though I only own 51% of the shares? Now, let's assume there are 12 members of the board. You would think I at most should get to elect, say, 7 of them, right? Because that's kind of proportionally with the shares. But under straight voting, it doesn't work that way. So if you are a minority shareholder, meaning you own less than 50%, you want the firm to have cumulative voting. By the way, that's a great test question. If I'm a minority shareholder, what would be my preference, straight voting or cumulative? You always want cumulative. And here's the way that works. Let's say that there are 2 seats up for election. And what that means is everybody, for every share, by the way, the shares get you the votes, right? 1 share, 1 vote. It's not democracy. It's not 1 person, 1 vote. It's 1 share, 1 vote. Okay, now, in this case, we've got 2 people up for election here. Everybody gets 2 votes. Now, we all agree on Mr. Tips, so he gets elected to Ms. Holden. We've been looking at your Facebook, and we're concerned about your health, right? And so I still like you, but because all of these people are putting both of their votes on you, they're not voting in this race at all, they're putting all of their votes on her, you can actually elect her to the board, even though I don't want her to be there because of cumulative voting. And the more seats standing for election at a given time, the easier it is to get someone on the board. Because now instead of, let's say there were 5 people up for election, you could put all 5 of your votes per share on 1 candidate, and you might be able to get someone on the board. Now, why is it important to get someone on the board? You might say, well, wait a minute. there's 12 people on the board. If I get one person on there, is that really going to make a difference? And the answer is, it depends on who the person is. Let's talk about how boards and CEOs interact. Do you think the board members and the CEO know each other? Yeah. Do you think they play golf together?
Yes.
Yeah. Do you think maybe their kids go to the same private school? Yeah. Do you think that perhaps the CEO helped a board member get a kid into a private school? Yes. Okay, now, what kinds of, so we've established that they've got this rapport. We also need to establish what kind of people serve on boards of directors. Typically, you're not going to have a competitor CEO on your board, right? Because they would be privy to inside information that would be bad for your competitor to know. So that's why when Google and Apple, when they started stepping on each other's feet, their executives pulled off of each other's boards. Until then, they had people on each other's boards. Okay, now let's talk about who's on there. Well, we've got retired CEOs. We've got retired Army generals and Navy admirals. We've got the head of the American Red Cross, and there's always one lawyer. There's always a lawyer. And so what we're talking about, intelligent, well-meaning people, but are they necessarily experts on the industry that that the company's involved in? No. So let's take an example here. You've got Boeing and Airbus. And the Boeing CEO walks in to the board meeting and says, you know, I realize our stock has really stunk lately, but it's just bad, bad, bad everywhere, so, you know, not my fault. And the board, because they're all good friends, the board's like, oh yeah, poor guy, he's got a tough break, right? Now, what if I instead could, as a minority shareholder, could get one person elected, and that one person would be a former CEO of Airbus. And that person would be in the room when the CEO was making this speech about how, yeah, it's just, you know, those are the breaks. And the Airbus CEO could say, oh! By the way, he's probably French, right? Oh! Merde! You already know what that means, right? Why is he saying merde? He says, look at Airbus. Airbus has got all sorts of orders. By the way, how many people has Airbus killed this week? Terrible joke, it's true, right? And now, do you think that the other 11 members of the board, that they might start thinking? Yeah, remember, we said they're intelligent, well-meaning people. Do they also want to avoid the shame of being called out in the Wall Street Journal for going along with this crap after they've had it shown to them that it was crap? Yeah, they want to avoid that because, after all, they want to keep their jobs. By the way, most directors have multiple board slots, right? They want to keep those other ones, even if they lose this one. And so that's the value of having someone on the board, just one. Having someone in there to call crap when they see it. Someone that's trusted and recognized by the other board members as knowing knowing what the hell they're talking about. Does that make sense?
Would Apple have Tim co-sign an NDA if he intends to retire to not go to Google's board?
You know, it's possible. How would you enforce that? So let's think about this. I'm saying, you and I already, I'm Tim Cook, and you're the Apple board. We already have an employment contract, and that contract already stipulates what I'm going to do, or you know, what's going to happen with retirement. And at this point, if you say, well, we want you to sign this additional piece of paper, what am I going to do? Right? I've never seen Tim Cook do that, but I can picture him doing it. Like, no, I'm not going to do that. By the way, non-disclosure agreements, there's some discussion now that they may not be legal. Yeah. Yeah, well, and basically, if there are only two companies doing something, Boeing and Airbus, and you make me sign an NDA, doesn't that just kind of deprive me of my livelihood when I leave your firm? Yeah. What about my children? What about I don't have kids. What about my dogs, right? Who's going to buy puppy chow now? So there's your argument against the NDA. Okay, yeah, I'm not going to take it. I have signed an NDA at one point or another. I'm pretty sure everything I know for that company is now totally worthless because that was over 20 years ago. Whew. Okay, other questions? So, how many shares must a minority shareholder have in order to elect one director? Well, if there are, so N is the number of seats being up for election this particular time. And so if it's 2, N would be 2, it would be 2 plus 1 is 3 on the bottom, so it would be 1/3 times the number of shares outstanding plus 1. Plus 1. Let's work an example here. Let's say there are 3 seats available and there are 10,000 shares outstanding. What's N? 3. What's N plus 1? 4. So that makes the first part 1/4. What's 1/4 times 10,000? 2,500, and I gotta add 1. That means you gotta have 2,501 shares to be guaranteed. Now, can you get your person on the board with less than that? Yes, but you have to get other people to go along with you. You have to get other shareholders to go along with you. And we call that a proxy fight. And we'll talk about that in chapter 21. Questions? Okay, now let's talk about classes of stock. Remember earlier I said that all common stock gets the same cash flow rights. And so these different classes of stocks will have different cash flow rights. What's going to be different between them are the voting rights. Example, Ford Motor Company. There are Class A shares and there are Class B shares. Class A shares, and I may have them backwards as to which is A and which is B, but let's say Class A shares have 10 votes apiece, and Class B shares have 1 vote apiece. Now, what kind of special people are allowed to own Class A shares? Blood descendants of Henry Ford and charitable foundations endowed by blood descendants of Henry Ford. Anybody in here a blood descendant of Henry Ford? I didn't think so. Every once in a while I have an Indian student raise their hand and then we all laugh, right? Because Henry Ford was not from India. Okay, back to the story. So none of us would be allowed to own these Class A shares. What kind of shares would we be allowed to buy? Class B. How many votes do we get per share? 1. How many votes do they get per share? 10. What does this allow the family to do? It allows the family, what's that?
Control.
Yeah, it allows the family to maintain control. Now, even if they just had 1 vote per share, they could have controlled it with 50% plus 1. But what does this allow them to do? It allows them to sell it down to where they only own like 10% of the farm, and they still can control it. That's the only reason that the CEO at Ford has the last name Ford more than 100 years on. Does that make sense? Because they've got these super voting rights. Now you say, well, certainly we wouldn't be doing that today. How about Google? Your friends at Google who used to say, don't be evil. Did you notice they dropped that? At Google they used to say, don't be evil. By the way, when they did their IPO, guess what? Sergey and Larry, they get shares with, I think it's like 3 votes apiece. And y'all get 1. What does that allow them to do? It allows them to sell down below their 50% level and still maintain control of the firm. Now, how is this a bad thing? This is a bad thing because the share class with superior voting rights, they can abuse the minority shareholders. Let me give you an example. A man named Carlos Slim, on and off again, the richest man in the world. By the way, where is Carlos Slim? Where does he live?
Mexico.
Mexico. He was actually born in Lebanon, or his family's from Lebanon. I forget. But he sounds like a character from a Quentin Tarantino movie. It's Carlos Slim. Okay, now, here's what you need to know about Carlos Slim. Carlos Slim, back in the day, is friends with people in power. And Mexico is going through something called privatization, which is where the state sells off state-owned assets. Now, in theory, what should happen here is those assets should be put up for auction and sold to the highest bidder, and the money goes into the treasury to benefit the people. Do you think that's going to happen?
No.
Okay, so here's what really happens. Carlos's phone rings. And Carlos answers the phone and he says, that's Carlos. And they say, hey, this is so-and-so at the Ministry of Privatization. Oh, hey, yeah, hey, great golf game we had last Sunday. Sure appreciate you coming out. Now, the guy at the Ministry of Privatization says, oh, yeah, we had a good time. By the way, we're getting ready to privatize Telefonos de Mexico. Did I pronounce that right? Teléfonos de Mexico? You speak Spanish, don't you?
Yeah.
Yeah, I thought so. Okay, it's a telephone.
Teléfonos de amigo.
Say again?
Teléfonos de amigo.
Oh, he's even better than that. Okay, now, well, he speaks Spanish, right? Okay, so it's Telephones of Mexico is basically what it is. It's a national phone company. And Mexican people, in their heart, they love Teléfonos de Mexico because that's how I call my mom, and it's, reach out and touch someone, that sort of thing, right? So he's like, I'd like, I'm sorry, but I can't afford to buy. Oh, and the guy says, we'll make you a really good deal. And Carlos says, hey, I still can't afford it. He's like, don't worry. We'll get you a loan from the National Bank at a low interest rate guaranteed by the taxpayers. Now, I may not have all the details correct exactly, but this is genuinely what's going down here, right? Now, do you think the guy that he played golf with last Sunday is doing this out of the kindness of his heart? What does he expect? A gift, right? He expects a gift. That's what they would call it in China. In Mexico, they may just be kind of straight up call it a bribe. I don't know. Now, he's going to expect some cash back. Now, Carlos has now bought this thing at a discount, and his cost of financing is pretty low. So he's like, how can I make some money off of this? Well, he knows that if he offers it up in an IPO and turns it into a publicly traded firm, that Mexican people love Teléfonos de Mexico. They're going to buy the shares, right? They're going to drive the share price up, and he'll be rich, rich, rich. But does he just want to be rich, or does he want to be mega rich? He wants to be mega rich. So here's what he does. Instead of selling off 49.999% of the firm and just being merely rich, he creates two classes of shares. One have special Carlos shares with 10 votes per share. The remaining 90% are peasant shares with 1 vote per share, right? Those are the ones he's going to sell to the people of Mexico. So he does this. He takes it public. He owns 10% of the shares, but he continues to control the firm because of his superior voting rights. And now, he's rich, rich, rich. But do you think that's enough to make Carlos happy? No. If you've got money, what do you want? More money, right? Okay. So Carlos like, how can I make even more money? He's like, aha! He sets up another company over here that he owns 100% of called Carlos Co. That's not the name of the company. Carlos Co. And what he does is he uses his superior voting rights at Teléfonos de Mexico to force this company to sell $1 billion worth of assets to Carlos Co. for $500 million. Now, the game's not over yet, because then he uses his superior voting power over here to force Teléfonos de Mexico to repurchase those assets at their full market value. What does that do to the value of Teléfonos de Mexico? Whoop! They're down $500 million. Carlos is 10% owner. He's down $50 million. Yet he is laughing and smiling and smoking a big cigar. Why? He made 500 over here, right? He only lost 50 over here. He's up $450 million. You say, whew, that's clever. Who gets hurt? Yeah, the peasant shareholders, right? They take it in the nose. Now, is that scumbaggy? Absolutely, that's scumbaggy. Could you make this work in the United States? No, and I'll give you the answer why. I want you to pick up, if they still make them, phone books, and look in the attorney section and see freaking how many lawyers we have. So we got a boatload of lawyers. We also have pretty good institutions. They're not perfect, but we have pretty good institutions. We also have pretty clear securities laws. In Mexico, do you think any of those three things? No, not necessarily. By the way, the guilty rate, the guilty verdict rate in Mexico for murder, it's around 2%. Do you think that they really bring cases of 100 people and only 2 of them are guilty? No, what do you think happens? Yeah, it's the best justice money can buy. It's like my cousin Harry getting out of jail for the bag of money, right? Okay, now, so you got to have corrupt judiciary, you got to have crappy institutions, and in Carlos's case, by the way, you should be in a country where they're doing privatization, which I think China will eventually get there, Vietnam will eventually get there. So when you get back to home to Vietnam, make friends with the people in power, right? And so make friends with the people in power, and then they'll make these deals available to you, And then you also need uninformed investors. Do you think the people in Mexico were sophisticated investors that were scooping up these shares? No. And so you got to have all those things. It really worked out well for Carlos, but for the people who bought the minority shares, not so much. Questions? Now let's talk about preferred stock. Why is it preferred? Do people like it more? No. It's because it has a preference for dividends and residual assets at bankruptcy. What does that mean? It means the preferred shareholders have to get their dividend before the common shareholders get paid theirs. Also, the residual assets at liquidation. You remember the big pot? The preferred shareholders get something called the stated liquidating value of their preferred shares, which is $100 per share. They get that before the common shareholders get anything. We also have something called cumulative dividends that are typical for preferred stock. So cumulative dividends, by the way, common stock has non-cumulative dividends. If they don't pay a dividend this quarter, tough luck. Right? It doesn't matter. But if you've got a preferred stock, most of which have cumulative dividends, when they don't pay, you're like, aha, they owe me $1. And then 3 months later, they don't pay again. You say, they owe me $1. And they have to pay back those dividends in arrears. They have to pay back those dividends in arrears and pay me the current dividend before they can pay the common shareholders anything. Okay, now, that means that preferred stock is safer or riskier than common stock? Yeah, it's safer because you get your dividend first and you also get first dibs on the assets before the common shareholders. What does that mean for the required return for preferred stock? Yeah, it's going to be lower than that for common stock. Preferred stock kind of actually looks like debt. Those fixed, by the way, we call preferred by a percentage. We say, oh, that's 5% preferred. What does that mean? It means it pays an annual dividend of 5% multiplied by that stated liquidation value of 100. So that means it's paying an annual dividend of $5 per preferred share. That looks a whole lot like coupons, doesn't it? Where you're getting the same money over and over and over again, and then you've got this stated liquidating value of 100. Looks a whole lot like the coupons on a bond and the face value. And there are actually some preferred issues that have ratings like bonds. In fact, S&P, Moody's, Fitch will all rate preferred issues. Makes it look like debt. And then some of these preferred issues have what are called obligatory sinking funds. Obligatory sinking funds. Now, let's talk about a quick example here. During the financial crisis, Goldman Sachs, by the way, what happened to the stocks of all banks during the financial crisis?
Went down.
Whew, right? And you can't tell who is clean and who's dirty, right? You can't tell. So what do people assume? They assume they're all dirty. Now, the guy, Goldman Sachs, Lloyd Blankfein's his name, he calls up Warren Buffett. You guys know who Warren Buffett is? He calls up Warren Buffett and he says, hey, Warren, it's Blankfein, how you doing? And Warren says, cut the shit, what do you want? And he says, we want you to make an investment in Goldman Sachs to prove to investors that we are in good shape. It's actually a smart idea. And so Buffett says, okay, I'll send my guy to check out your books tomorrow. So his guy flies in, the next day he goes, checks out the books. That night he calls Warren. He's like, yeah, they actually have their crap together here. This would be a good investment. And so Warren calls Blankfein and says, my guy says everything's cool. What do you propose? And Blankfein says, we would like for you to buy common stock. And Warren says, no way. Warren says, I'll buy preferred stock. Why would Warren buy preferred stock and not common stock? Because if things do go sour, he wants to get his money back before the common shareholders. Does that make sense? And Blankfein's like, okay, whatever. And then Warren says, well, what were you thinking as far as a percentage on the preferred? And Blankfein says, 5%? And Warren laughs. He says, make it 10. And Blankfein says, yes, But you've got to allow me to have this sinking fund where I can buy that preferred stock back. Because 10% is expensive money. I don't want to be paying for that till the end of time. Does that make sense? And so that's basically how the deal went down. Now, do firms have to issue preferred shares? Boy, he's excited to be here. Do firms have to issue? No. In fact, when I see preferred shares in a capital structure, it makes me think this company's been in trouble at one point or another, and they've had to do the Warren Buffett call.